We start today's market talk. Issue issues and solutions. This is what we have seen over the last few days, and this week we had some fairly big issues seeing solutions. US conducted airstrikes on Iranian nuclear facilities, prompting Iran to retaliate by targeting American base in Qatar, which was already empty. After that, Trump announced a ceasefire between Israel and Iran. Then US agreed to a trade deal with China. US also indicated that trade deal with India is in the near future. So most of the issues are finding solutions and market is taking it well. So the question is, all is well with a question mark. So is all well? I don't think so, because though Israel-Iran war is over, China and US seem to have arrived at an agreement to ease some trade restrictions, especially on rare earths. S&P 500 and Nasdaq are at all-time high. Shrill rhetoric on tariffs has died down. US bond yields are off their highs. Fed fund futures are now pricing 2 to 3 25 basis point rate cuts by end of the year. So everything is good, and that is what the market is reflecting. And in addition, the NATO members agreed to an ambitious defense spending target of 5% of GDP by 2035, creating new opportunities for weapon manufacturers. So, average military spending among NATO members stood at 2.2% of GDP. US defense companies account for 60% of the NATO weapons imports. If the signal which are emerging is that security in the society is the main consideration and rest of the issues are not that important, then defense would be a prolonged theme for a long period. And money will move from social programs to weapons. It guarantees a decade-long expansion of defense industry, creating new opportunities for weapon manufacturers and defense contractors. It will lead to rise in debt to GDP of these countries. But nobody cares today. It will trigger an arms race. Rest of the world will have to keep up. So if rest of the world has to pursue independent foreign policies, they will have to spend more on arms. So defense is a long-term theme now, at least for 5 to 10 years. Countries will have to align their defense policies and purchase weapon systems aligned to their partners. Markets have learned to evaluate all crises through one critical question. Will this disrupt the next earning cycle? If not, it's business as usual. I find a lot of people are very worried. But what is happening is, despite all the conflicts, global markets continue their resilience. Fed put phenomenon has created investor confidence that monetary authorities will intervene forcefully during any major crisis. Passive investing and algo trading now dominate, responding to technical flows rather than emotional reactions, so nobody is bothered. If conflict doesn't interfere with earnings, interest rates, inflation, supply of critical material, it is just a background noise. So wars can go on, nobody cares till the time oil prices are below a designated level. Now, coming to India specifically, without a pickup in private investment or revival in global growth, the current environment offers limited upside because there are structural constraints in consumption and absence of new catalysts may keep the outlook cautious. Top line growth of Nifty 500 is in low single digit, and margin expansion remains the driver of profit growth. This could challenge current valuations. Growth expectations are priced into many stocks, and in some of them more than required. While corporate India is showing reluctance to step up capital expenditure, most of the growth is due to government spending. We saw in the GDP data also. It is the government capex which is leading to basically the GDP growth. Private sector is not contributing till now. BSE 500 median trailing PE is around 38x. That is 38 times, and earning growth is just 9%. So the median PG is 4x. That is well above sustainable level. So that is the one why I said that it is not that all is well actually. Now, if you see this, the top line is stagnant. while margins are nearing their limit. So if you see Nifty 500 ex BFSI, that is banking and financials, revenue growth has come down to around 4% from much higher levels earlier. And EBITDA growth is somewhere close to around 10%. And it is going down. So earnings are not showing right now, and especially with the top line growth. Now, coming to FIDI data, this is what I was referring to. If you see, just analyze this 27 June FIDI data, this will tell you exactly how at least the opening will be there on Monday. So if you see here, FIs have cut down their short positions. They were around a lakh odd short positions. In index futures, it has come down to 33,000. But what they are doing, they have around 43,000 positions in call options index and 40,000 in put options. So what is happening is they are majorly on the downside, that they are expecting market should go down. Now, what are the pros doing? Pros have around 11,000 odd short positions in index futures, but they have huge amount of call options, 2.94 lakh call options they have bought, and very limited put options. So what they are expecting is they are expecting that the market should go up. And if you see this index futures thing, so this and call options along with that is just hedging. So basically the FI's orientation is down while pros orientation is up. And now who is the counterparty here? Counterparty here is the clients who will get butchered because they have net sold call options, so roughly 3.37 lakh. So this is the issue. So this is what it indicates exactly as to what is the orientation. And generally you should be with the what the FIs and pros are likely to do. Now coming to monthly data for the action. So if you see, it's very clear. Uh, the the number of index future short positions have declined from around a lakh throughout the month to around 30 odd thousand now, basically because of uh, net long positions of 70 odd thousand crores added, 70,000 odd positions added on 26 June, which led to a rise of around 1.21% and index breaking out from that range it was there to 25,500 plus. And on that day, there was a big cash buying. Another day, there was a cash buying. Again, there was 1.29%. And again, during the week on 6 June, there was uh, a net addition into long positions and index went around 1%. So it is the action of the FIs which is determining the large move in the index, which you can easily see. And those 1% day moves are the ones which are giving that bounce in the index. So now they have taken it up to 25,500 plus level. Let's see what happens from here. Now coming to US, uh, all their indices, that is S&P 500 and Nasdaq, made a fresh high uh, after 2-3 months of action. Sentiment was driven by end of 12-day conflict between Israel and Iran, which brought crude prices down and tamed the inflation fears. Final push for stocks came on Friday following finalization of trade agreement between US and China, under which tariff rates will come down and rare earth exports will be expedited. So that is sorted out, and that is what they were looking at. US Q1 GDP estimate was revised lower and core personal consumption expenditure price index was higher. That is inflation, but nobody bothered because they will be managed subsequently. Powell continued with his wait and see approach, while other Fed governors are now talking about a possible rate cut in July Fed meeting. Hence, now the markets have started pricing in at least 2 to 3 rate cuts in calendar year 25. And the chip maker Micron Tech reported solid quarterly results and guidance, which led to the rise in Nasdaq and all chip-related stocks. So if you see here, the US bond yields have started coming down. They were down 2.33% for the week. They have come down to 4.27 level. I think if this trend continues, it will come down to this 4% level, and then we will see what happens from there. This is what they were looking at. This is followed by decline in the dollar index. So dollar index has declined around 1.54%, and it is heading to this 93.954 or around 94 level. It will head there, and this is again helps them in their trade deals, etc. So this is the another thing. So now the net result of decline in dollar index is that the money will move out from US dollar into other asset classes, that is equities, metals, etc., and that is what is being reflected. So the Brent crude fell around 14% from its high around 80. It has come down to the level of 67, 68, and I think as the things cool off more and more supply hits the market, it will come down further. So it should come down to that 60, 65 uh, range. Gold has broken the trend line. It had never broken the trend line by which it was falling. It was going up till now. So here, this is a clear breakage of the trend line. It fell around 3%. And let's see if it goes up to this 20 EMA, around 3200 or so. If it goes there, that should be the first buying opportunity to get into gold for long term. Silver has had a breakout above last high, and now it is seeming to go up because of a lot of demand, etc., and difference in prices between silver and gold right now. Copper has broken out of the top it had made, uh, top it had made twice or thrice, and now it has clearly broken out. It was up around 4.84% last week, and this is in a breakout. So metals are likely to do better now as the dollar is weakening and the trade related issues are sorted out. Bitcoin also gained because this is where the money is moving out from dollar into cryptos. It was up 6% after, and it fell with the fear of the war, and now it is recouping those losses. S&P 500 has broken from its last high, which it made in February. So it has made a fresh high, uh, was up 3.44%. Nasdaq is again made a fresh high. So it was up 4.2% with good numbers and good guidance from all the chip makers. So it is heading higher now. And in the channel, Dow also was up 3.82%. And let's see if it gets into this upward channel it was there earlier. Now coming to India, uh, India VIX has declined, so it has come down to 12.38 level. Very good decline this week. On all 5 trading days, it has declined, and so now I think it should remain at around these levels. It can't fall below this. Now, Nifty 50, if you see, it had a very solid green candle, very strong green candle, and it is above that 78.6% retracement. So, this 25,300 should be a decent support because this was the one which was proving to be a resistance for over 2 months or so. So, it has finally taken it out. So, this should be a support. And after this, once you have taken out the 78.6% retracement, move to that all-time high of 26,277 is a formality now. It's an imminent issue. So let's see how much time does it take, but it will go there. So that is not an issue. Now coming to daily chart. So if you see here, this is making a clear Elliott wave pattern. So this is wave C now. So this was wave 1, then there was a decline, wave 2, and now this should be wave 3. Generally, the wave 3 is greater than, or the best wave actually in the whole pattern. So this is 3,000 points. So this can easily go around 4,000 points higher from the bottom. That was around 24,500. So don't be short, etc. So try to stay aligned with the trend, and don't over anticipate reversals. So generally remain on the long side and use dips. Dips will be there because the pattern is breakout, retest the support, and then the trend continues. So we have seen a breakout. It will retest the support 25,300, 25,000, and then the trend will again continue. So that should be an opportunity to buy because the support is at that range 25,000 and 25,300, and the first target should be 25,800 from here, and then this should go to subsequently the previous high of 26,277. So we have had seen 2 weeks of positive run, and the congestion zone which it was stuck for a long time here has been taken out. So stay with the trend. Now, if you do the Fibonacci extension of this move, if you see the easiest target is 26,088. So roughly around three from here, around 300, 400 points is just for the taking, and after that should be the next level. 2-3% move is not very difficult right now, at least before the earning season. Hourly chart, if you see here, if you see, we had a very shallow dip on Monday despite all the negative news of which we had discussed last time regarding the Strait of Hormuz, etc. But Nifty didn't really go below 24,800, and then from there it bounced. Then after that, Trump had announced a ceasefire, so there was a gap up. Then it came down, took a support at 20 EMA, and then after that there has been steady rise, followed with a breakout on Thursday. So it has now come down to that 25,600 plus level. So it should continue to remain in this upward trend. Nifty Bank again had a solid breakout, 2% move, and it's made a fresh high. It's broken above the previous high of 57,000. So this 57,000 should provide the support here. So that is the place to remain long. On the daily chart, it has broken above this previous high. All days it was going up, and it has now made a fresh high. So it is expected to move higher from here because it has made a flag. I had told you about this flag pattern. So the length of the pole was roughly around 5,000 points. So from the lower level, roughly around 54,500, it can easily go to 60,000 from here, technically. Now the move was due to HDFC Bank. It broke out with large volumes, broke that long-term target of 2,000 plus. So now it has gone above that. Friday it was subdued because there was a dividend issue, so dividend has been adjusted. But I think it should resume this rally. So that dividend is marked here, but then it will resume its rally from here. So don't be bothered about this. This stop loss should be this 20 EMA 1960. Above this, it is positive. The other support came from Reliance. It was up 1.34%. It has broken through that 1500 out level. So now it is expected to move up only because I think it is going up with decent volumes. So it should do well. Now midcaps have already midcap select index. So if you see here has reached its previous high. So this is positive territory, and I think with this momentum now, and if the results are good, then it should head for fresh highs. So above 13,000, midcap select is again a long trade. Small cap again, it is approaching. It's around 3% from the previous high of around 19,600. So once it will approach there, then we will see a decent breakout because Nifty has already moved. Now the time has come for mid caps and small caps to move a bit more. Now coming to two stocks which I'll cover today. First one is a very interesting stock. Firstly, PB Fintech, what does it do? It provides end-to-end insurance and credit solutions to consumers. So this is the basic thing which it does, and it's a kind of a platform for insurance and credit solutions. So firstly, it has got Policy Bazaar, which is the insurance marketplace focused on Indian middle class families buying protection against death, disease, and disability, and also provide end-to-end solutions to retail consumers for various aspects of life. So it's in a critical long-term growth industry, and they are doing generally well, and they have good products. I'll discuss about it subsequently. The second is Paisa Bazaar. which is a credit marketplace focused on credit availability and convenience for all. Again, a strong growth sector. The third is PB Partners, a enablement platform for over 300,000 partners to help them manage insurance sales using technology. So these are the agents, erstwhile agents now, who are called PB Partners. So they are doing selling of insurance policies through the platform of Policy Bazaar and also credit through Paisa Bazaar. Now, it is the largest online platform for insurance and lending products. Core premium growth remains strong in health, life, and renewable segment, sets up a strong recurring EBITDA trail. Medium term sustainable new business growth guidance is 30% year on year. High multiple, it's trading at FY27 80 PE today. So what they are saying is that there is expectation of PAT growth of 35% over the next 10 years, which I feel is slightly uh, overestimation. But this is the present thing, and that is how they are justifying the present earnings. It has a strategic advantage in health insurance, and this is like when you analyze any stock, you must analyze what is the moat in this, what is the competitive advantage of the stock or moat of the stock. In my opinion, the competitive advantage or a moat of PV Fintech is the health insurance part because of good disclosures at the beginning, and it has a higher claim settlement ratio, which is allowing it to incrementally attract more customers. This is the key differentiation from the other companies which are having kind of a shoddy products. Then their annual renewal revenue remains the bedrock of earnings ahead because increase in annual renewal revenue is also a function of strong persistency ratio. I'll explain it later. To expand its secured lending business, it plans to introduce new products such as home loans, loans against property, loans against cars, etc. It is likely to now start distribution of saving products like FDs and bonds. So what is happening is from unsecured lending, they are moving into secured lending. So where though the margins are reducing, but the NPS will also reduce. Now they have a lot of new initiatives which includes PB Partners, PB Corporate, UAE operations, and also PB Connect. It has reported a contribution profit for the third consecutive quarter in Q4 FY25. So I'll cover these new initiatives subsequently. It has launched a new healthcare venture called PB Health, securing 218 million of seed funding. This move signifies its diversification into hospital infrastructure. It wants to get into hospital infrastructure from health insurance, leveraging its insurance expertise to build an integrated healthcare ecosystem. So this is kind of a backward integration for them. Now coming to their earnings. So if you see here, Q and Q quarterly earnings, the standalone premiums grew 35%, while new initiatives, which I have covered already, PB Partners, PB Connect, PB Business, and UAE Part, has grown roughly around 41% year on year. Total was 37%. The revenue, core revenue, has grown 45%, and new initiative revenues have grown around 49%. Take rate is now improving. So core is now 16% and new initiative is 27%. Now coming to the Paisa Bazaar dispersal, the the dispersals have grown 115% year on year, but the revenue has decreased because they are now getting into lesser of unsecured parts. So because lesser unsecured is, and they're getting into more secured because unsecured has higher margins. So the take rate has reduced for them. Total revenue is up 38% year on year. Contribution is basically revenue after deducting variable cost from the sales, that is profit before fixed cost. So the contribution margin is improving, and contribution from whatever revenue they get for them after variable cost is 43%. So that's a high margin. So fixed cost, taking it out, fixed costs are actually coming down as a percentage. So adjusted EBITDA margin is improving. So it has come down to 9. It has come up to 9.9%, and it has grown 115%. So considering all this thing, their adjusted profits after adjusting for ESOPs and expenses, has is growing at 67% year on year. So this is the reason this stock is trading at very high valuation. Now coming to the yearly revenues, so the premium standalone was up 42%, total premiums were up 48%, disbursals were up 38%, total revenue was up 44%, contribution were up 33%, adjusted EBITDA up 131%, and adjusted EBITDA for ESOPs and expenses was up nearly 39.8. So 40% growth. So this is why, if they are figuring it out that this is likely to grow at 25 to 30% over the next 5-10 years, that's why it is getting such a high uh, earning ratio, P ratio, etc. So this is the basic thing. Now the growth is basically in health and life insurance with structured foray into secured loan distribution. Contribution margin I have discussed, it is already improving. Uh, and improvement in contribution margin is across segments. They are gaining market share. Strong annual renewal revenue is also helping them, and client base is improving because of good advertising and good performance. So core premiums are improving to 35 to 45% over the last 7-8 years. So persistency is basically, like we discussed about, persistency is higher because it is a number of people who stay with the PB Fintech after first year's renewal of policies. So if there is, they stay with them, renew their policies for various kinds of insurances, so that it remains a good, that persistency remains high, and the annual revenue which is renewed remains at 80, a very high margin, that is 80% margin. So number of people who have had more than one renewal also helps in the higher persistency ratio. So for insurance, persistency ratio is very important because it leads to higher margins because you don't have to spend money on client acquisition. It has introduced new products, which is very critical because they have very high no claim bonus. So what happens is, if the no claim bonus is high, the people can go for higher sum assured. Otherwise, what happens is, a lot of insurance product used to have very low no claim bonus. So that is again which is helping them. Uh, Now, growth policy bazaar. So if you see here, registered consumers are constantly growing. So now they have reached around 10 crore registered consumers. Newly added consumers are also growing. Transacting consumers are roughly around now 2 crore, 20 million. That is 2 crore. First time transacting consumers are also growing. Policies sold are increasing, and new policies sold are also increasing quarter on quarter. Paisa Bazaar growth in transaction and customers is again improving. Newly added consumers are slightly declining, but they can always improve it. Transacting consumers are improving, and transactions are also up. See how many people are getting onto their website trying to see their uh, credit score and all those issues. So this is the way they are able to sell their products. So the total premiums are going up, so that is one. Disbursals have increased. Then total contribution and contribution margins have improved. Operating revenue grew 38% year on year. Fixed cost trends are now stabilizing, and adjusted EBITDA trend is improving. So this is helping them in turning profitable. Now, what is expected for them is, this is roughly right now a 82 crore market cap company. So 82,000 crore, sorry, market cap company, and it in FY27 it is expected to do around 1,000 crore of profit, net income adjusted. So and margins are expected to improve now as the operating leverage helps and the net sales increase, etc. So considering that 1,000 crore revenue and 82 crore, so presently it is at 80p, so slightly expensive. It is expected to do around 19 odd EPS in FY26 and 22-23 in FY27. EBITDA margins are improving, contribution margins are improving. Revenue growth is around 28% odd. EBITDA growth is very strong, 500 basis point. EPS growth is again 59% because it is coming from a low base and used to be loss making. So valuations are expensive, but they are expected to come down if they maintain their rate of growth. Now, this stock had gone up to around 2200 levels, came down. Now it is on rising now because there was a stake sale by the promoters. So the stock has corrected, come below the 20 EMA, but somewhere closer to 1700, it's a good buy. I have sold a 1600 P for this because if it comes there, I'll buy this stock. So this is a good opportunity, but it has been sold off with good large volumes because if promoters are selling, etc. So that is a big negative. Now, what they are doing is they have certain platforms called PB Connect. It's a consolidation platform for direct sale agents for loans. Then PB Partners is a platform for independent sellers of insurance and other financial products. Then PB Business is a platform for the corporates for group term and group health insurances, and they are now spreading in the new initiatives into UAE and selling health, life, and life insurances and loans out there. So that is how they are spreading their business. Now the next stock is Interarch Building Solutions, largest, second largest player in India's rapidly growing pre-engineered building solutions industry with a production capacity of 161,000 metric ton per annum. The market leader is Kirby Building Systems, but they are also increasing their production capacity. Current order book is roughly 1,646 crore. They are doing roughly 1,400 odd crore per year. So order book is healthy. Book to bill ratio is 1.2. Recently, it achieved a significant milestone by securing India's largest PEB contract valued at 300 plus crore. So if they get a big contract, it takes care of your revenue for the year and the margins are better. It is targeting a capacity increase to 2 lakh metric ton per annum by FY26 and 2 lakh 40,000 metric ton per annum by FY27-28. Expect a revenue EBITDA PAT CAGR of around 20 odd percent over FY25 to 27. Repeat order ratio is exceeding 80%. So this is good because the moat is this for them, their repeat order, because what happens is that the clients are satisfied and then they keep coming back again and again, serving prestigious clients such as Aditya Birla Group, HUL, and the Tata Group. It has acquired additional land at Andhra where it aims to add heavy steel structure capacity of 20,000 metric ton per annum, phase 1 by July 26. Now, how it will help is it has got higher margins and then it adds on to a new kind of a structural capability for them. At Gujarat land parcel, it expects 20,000 metric ton per annum capacity for pre-engineered buildings to be operational by Q4 FY27, which will mark its Western India footprint. Further, the Andhra land has a capacity to scale the heavy structure capacity to 60,000 metric ton per annum, unlocking its capabilities in high-rise residential and data center projects. Now, the key competitive advantage for them is that in-house expertise forms one of the company's key competitive modes, enabling efficient, precise, and optimized structural and architectural design solutions for these projects. So they have their own engineers which are able to help the company in creating uh, the architectural design solutions for their projects. So this is again a big advantage with them. Now, coming to the quarterly revenues, so the revenues were up 20%, EBITDA up 29% because margins improved, and profit after tax was up 30%. So strong quarter. For the full year, the revenue growth was 12%, that is around 1450, and 20% EBITDA growth and 25% profit growth. So they did an EPS of around 68 at 20% also, minimum 20% growth for FY26. They should easily do 80 plus EPS. So at 30p, it should the profit is growing at 25%. At 30p, it should easily trade at with 80 EPS around 2400. So it has been doing various projects, complex projects, airports, hospital building, tire manufacturing, industrials and logistic park, air conditioning manufacturing, FMCG manufacturing, solar PV modules, data center, etc. So they have increasing their capacity regularly, and volumes are increasing and utilization levels are also improving. So they are expecting higher levels of utilization so as to be able to increase their revenues. So revenues are constantly going up. So they should hit more than 2,000 crore in FY27. EBITDA margins are also improving. PAT margins have improved, and our ROE, ROC are now stable at around 16%. So they are expected to do around uh, revenue of 1788 crore in FY26 and 2100 plus in FY27, with the EBITDA margins and ROE, etc., remaining at decent levels. So as I told you, 80p in FY26 and 80 EPS with 30p should easily trade at 2400 plus. So it is at now around 2100, and it is taking support at 20 EMA. So it's a recently listed one. Around a year plus back, it got listed. So it's a decent business with not much of issues related to it. In case the industrial infrastructure will be built, this will keep getting into businesses and all those issues. So it's a nice level to accumulate this stock for long term. I finished. We'll take questions now.